voluntary carbon markets are exactly that. They're voluntary. Does that not render them speculative and unpredictable?
It's our view that when corporations, and now approximately 4,000 major corporations, have taken on a net zero or carbon commitment. And it's our view when they take that on that they're actually creating a semi-compliance state to things. And I think in terms of what Chairman Gensler is doing at the SEC, which is going to force companies to report on their milestones, progress, and plan around this, that is just, again, kind of changing the game.
I would maybe add that the compliance market are enforced through penalties, voluntary market are enforced through credibility and reputation.
How big is the voluntary carbon market today, and what are your expectations over the next decade?
Well, I would say this year in 2021, I think the voluntary market's going to be approximately 1 billion tons, give or take. Wow. A couple of 100 million. So 1 billion tons, and you have a range of costs, right? You have some folks like Airbus buying direct air credits from Occidental at 200 plus a ton, all the way down to lower cost methane capture from a landfill in China tons at the low end of the spectrum, $2-3. So there's a wide range, but I'm going to say an average price, in the $8 to $15 range. So you're looking at a market that is probably 15 billion or so in size, maybe 20 billion in size this year. Now, where do we think that's going 10 years from now? I mean, the growth is rapid. We're seeing the market grow by 2, 3, 4x per annum the last 2 years. And when we look out into the future, we start to look and see a path when you start integrating Article 6 in the Paris Agreement and how offsets are going to fit into that. You start to look at a market that can be north of $1 trillion. And these are markets that I think 10 years from now are going to be bigger than the crypto world, your multi-trillion-dollar asset class.
Explain the drivers for both supply and, of course, demand.
So these are growing demand sources, and we're moving up the cost curve. So the more demand there is, you have to find the matching supply. And so supply is really across the board, from nature-based solutions to technology-based solutions, from avoidance and removal. And we're going up a cost curve. So the fair market price of the marginal ton of carbon is really based on the cost of the next ton, or what the cost is to generate the next ton. And then we come also discussion, I think you wanted to touch upon a bit later, is what drives the prices is really the timing mismatch and demand. And that is an important notion, and also underlying the thesis of our fund to some extent is that demand is a budget decision. It's often people who say, how much do we want to allocate towards net zero? And that's a boardroom decision, it's a money question. But if somebody says, we will need 1 million tons down the road in the future or to next year to offset our emissions, to create the equivalent 1 million tons of supply might take you 3 years. So there's quite inflexible supply to a very flexible growth of demand. And we believe that this friction is going to increase price pressure. On the supply side right now, there's been a lot of discussion around what's, how good integrity-wise or how desirable are tons from avoidance projects, and the other one from removal. And in particular for removal, you can say technologies either early stage and expensive like direct air capture, or if you have sequestration forests, it takes a long time. And so you can't quickly ramp up growing a forest. Right? It just takes you 5 to 10 years for the trees to absorb. So really, if you have a fast growing demand for removal-based tons, that is a problem to ramp that up.
What types of carbon offset projects would you say are the most attractive?
Maybe we can take two categories. One is attractive from an integrity point of view. meaning a project which is at the moment is a proxy for, let's say, environmental benefits. We often use the Sustainable Development Goals, there's 17 of them, and projects often list which of these 17 Sustainable Development Goals, can be from poverty relief to biodiversity protection, gender rights, and so forth, are addressed with the project. And so the more of these environmental and social co-benefits a project unlocks, the more attractive it is from a co-benefit side. And then from an integrity point of view, there's also different technologies where you can very clearly quantify the carbon reduction, sometimes a bit more soft factors. But the others also, which we look at as well, is how commercially attractive is a credit.
So in our mind, corporate client should not be using a 2013 credit to offset whether it be a shipment of LNG or their net zero footprint. We think that's really kind of today those projects would no longer be additional, and we just think that there is some decay over time. And so that explains the low end of the range. In general, we're getting along the market in an $8 to $15 range. There's a lot of commercially viable opportunities in that space, and we think there's a potential for 10x price appreciation.
As soon as you engage into 5 to 10-year contracts like we do, to also provide some predictability to the developers. If we assume that you get a premium price for a project with a lot of these co-benefits, compared to one without the co-benefits, you get a premium for the price. But on the other hand, you have also an embedded risk around these co-benefits. And I think this is really where our team's experience comes in in terms of execution, monitoring, verifying due diligence and everything to make sure that what we believe is value, that we are able to convert this commercially as well in these kind of soft factors as the social and environmental co-benefits.
As you see, the second and third generations of wealth, particularly in the family offices and the high net worth family offices, they have a mission, right? They want to help contribute to making this world a better place and making money while doing so. And so, this skill set that we all bring to the table and the impact that we have, I think is something that we look forward to sharing with investors.
In considering exposure to a new asset class, investors will be keen to understand how a carbon offset fund would correlate with other parts of the portfolio. Is there any data that exists to support that? Let's go with it's uncorrelated.
Let's look at what does carbon markets or our portfolio in this case constitute, right? So in itself, it is already incredibly uncorrelated. And I would think there's hardly a market that is as diversified as carbon. Since right. We have participating countries, literally every country in the world. I mean, we won't source from every country of the world, but from a very broad variety of countries in itself. So country risk is already mitigated to some extent. Then you have a high variety of technologies, from tech-based stuff with high capex at the beginning, new technologies or established technologies, down to nature-based projects, which in itself has a very different dynamic depending on the kind of project, of the kind of developer. And lastly, the value creation is not a single market. So if you only are based on the EU ETS of California, you're dependent on the market development over there. But voluntary carbon has a variety of outlets. So you can sell to corporates, to governments, into different compliance schemes, to consumers on the platform. So I would say that in itself, it's an incredibly widely spread and uncorrelated product in itself.
I understand our before mentioned friends at Accordia have been working with you to develop the Ruby Carbon platform. Share with us how you will utilize that big data ingestion to help determine the highest quality carbon offsets.
So we have taken the basic risk management system of Ruby, which can be used for a variety of financial and equity instruments and commodities. And then we've built a carbon platform on top, bespoke platform with them, and we call it ICOS. So it's the Intelligent Carbon Offset System. And what Ruby does for us so well is it gathers that complex data of the 5,000 plus projects or more, and the others that are coming down the line from 5+ different registries that are out there. And there's a whole process that you have to go through in terms of registering, verifying, making sure these reductions happen in different stages of issuance along the way. But we're able to track and import all that data in real time. And then we're able to look at it. And what we've done is that we've built a proprietary system where we score it from 37 different factors. So I think there's 7 or 8 just on country risk alone, where we're looking at, because we're building a diversified, portfolio, but we're looking at everything from the ability to enforce a contract, what the CIA risk rating is, what some of the financial ratings of the sovereign debt are in that country, the ease of getting electricity. So there's a bunch of different factors that we're looking at but overall, we look at quality. We screen for quality, commercial opportunity, and then risk. And those are the broad buckets of how we look and screen using the Ruby system. And we're looking at country, project type, methodology, technology. What's the developer's track record? If they write up a deal and say, this project's going to produce 100 tons and they produce 70, their batting average is 700. And so we start incorporating all of that through this tool. At the same time, Larry's able to pull up the portfolio and look at portfolio-wide risks and individual-wide risks. And we can tailor and address the portfolio in that way as well as for us even booking trades. And so it's a multifaceted tool. They're fantastic to work with. They've been able, I don't think they've said no yet to one of our requests. So we're happy with them as a partner.
Understanding the cost curve will be very important. Please help our audience understand exactly how the cost curve would tend to operate.
Power markets have a stack model, and the more power demand you have, you bring in the more expensive plants over time, right? And so, and in carbon the same. So you can imagine it's almost like a stair where, depending how far you want to get, you go up the ladder. And this cost curve is called the marginal abatement cost curve, where you have all sorts of factors that determine the price, which might be the actual production cost, but it might also the time gap, whether it's more capex, opex heavy, and so forth. And so there's a variety of these MEC curves being developed by certain banks and advisors. We're also developing our own MEC curve. And so these will shift over time. So like Andy mentioned earlier, for example, direct air capture at the moment with north of $500 per ton is at the very end of the cost curve, right? So it's not, so there's a lot more opportunities to reduce carbon at a lower price, but over time, this will surely come off. Renewables cost curve, if we compare prices of wind energy or solar energy, they came off by 90% over time. And we expect this to happen for some of these carbon specific technologies as well.
How long does it take on average to plan, to fund, to implement a carbon offset project?
Okay, so I'll take this one. So your base period is already a year, because typically projects are being, once they're operational, they're monitored for 1 year, and then at the end of the year, somebody says, okay, what did you do during this calendar year? And then they get verified. So it's already 1 year minimum. Then the question is, how long does it take from planning to construction, financing to operation? That often takes anywhere between 1 to 3 years. So we have 1 to 3 years plus the 1 year operation. And then it takes normally, again, about half a year to then issue these tons, sometimes longer if there's bottlenecks, just administrative bottlenecks. We've seen in the CDM market 10 years ago that can take up to a year. If basically demand outpaces administrative capacity. So I think the quickest is probably cook stoves. You can roll this out within, let's say, half a year. Afforestation, on the other hand, you plant trees, you wait 8 years until your first issuance.
The life of the fund, I mean, it's a 5-year investment period, 5-year harvest period, but the focus for us is that it's going to take time to implement these reductions. And we also have the thesis that whether it be the Paris markets, governments buying other emissions trading systems, or just corporates on net zero, we think peak demand begins in 2027, 2028, when companies that have taken on these net zero, claims, they've done a lot internally to try and reduce their footprint. They've switched to cleaner sources of energy, either renewables or hydrogen or et cetera. At some point, and we think, peak is 2027 to 2030, they have to turn to the market. And they have to buy credits that enhance their reputation, don't put it at risk, don't put them at risk with a greenwashing claim. And that's where we come in.